Now, Italy's 10-year bond yield just under 3.6%. That's the benchmark borrowing costs that we look at when we look at what Italy would be able to borrow at on the markets. This is how it's been creeping up since the start of the year. You can see a spike when the government was formed in May there, and creeping up a little bit higher as we got closer to this budget standoff with the European Union.
Italy, known for its rich history, vibrant culture, and significant contributions to art and science, has faced severe economic challenges over the past decades. Despite being one of the largest economies in Europe, Italy has struggled with stagnation, high public debt, and structural issues within its economic framework. As we enter 2024, questions about Italy's ability to recover from its economic downfall remain pressing. This video will delve into the key factors affecting Italy's economy, examine recent data and studies, and explore potential pathways to recovery. Italy's economy, the third largest in the Eurozone, has been characterized by sluggish growth, high unemployment, and substantial public debt. The COVID-19 pandemic exacerbated these issues, pushing the country into a deep recession. However, as of 2024, there are signs of both challenges and opportunities on the horizon. In 2023, Italy's GDP growth rate was a modest 1.2%, reflecting a slow recovery from the pandemic-induced recession. This growth is primarily driven by a rebound in tourism, manufacturing, and exports. However, it remains below the Eurozone average, indicating underlying structural problems. Unemployment in Italy stood at 9.5% in early 2024, a slight improvement from the previous year but still high compared to other Eurozone countries. Youth unemployment remains a critical issue, with rates exceeding 25%, reflecting a significant challenge for the country's future workforce and economic potential. Italy's public debt is one of the highest in the world, reaching approximately 145% of GDP in 2024. This high debt level constrains fiscal policy and limits the government's ability to invest in growth-promoting initiatives. Several key challenges continue to hinder Italy's economic recovery. Italy's economy suffers from deep-seated structural problems, including an inefficient public sector, a complex and burdensome regulatory environment, and significant regional disparities. The southern regions, in particular, lag behind the more industrialized north in terms of economic development and employment opportunities. Italy faces a demographic crisis, with one of the lowest birth rates in Europe and an aging population. This trend puts pressure on the country's pension system and healthcare services while reducing the labor force's size and productivity. Political instability has been a persistent issue in Italy, with frequent changes in government and policy direction. This instability undermines investor confidence and complicates the implementation of long-term economic reforms. The education system in Italy struggles to meet the demands of the modern economy. There is a significant mismatch between the skills taught in schools and universities and those required by employers, leading to high youth unemployment and underemployment. In its 2024 winter economic forecast, the European Commission highlighted both positive and negative aspects of Italy's economy. While acknowledging the recovery in tourism and exports, the Commission pointed out the need for structural reforms to address inefficiencies and boost productivity. It also emphasized the importance of fiscal consolidation to manage the high public debt. The OECD's economic outlook for 2024 provided a mixed picture of Italy's economy. The report noted that Italy's growth prospects are constrained by low productivity growth and demographic challenges. However, it also identified areas of opportunity, such as digital transformation and green investments, which could drive future growth if adequately supported by policy measures. The Bank of Italy's annual report for 2023 highlighted the need for targeted investments in education, infrastructure, and innovation to boost long-term growth. The report also stressed the importance of improving public administration efficiency and reducing bureaucratic hurdles for businesses. Despite the challenges, there are several potential pathways for Italy to recover from its economic downfall. These pathways require a combination of structural reforms, strategic investments, and effective policy implementation. Structural reforms. Improving the efficiency of the public sector is crucial for enhancing overall economic productivity. Streamlining administrative processes, reducing bureaucratic red tape, and increasing transparency can create a more conducive environment for business and investment. Addressing the rigidities in the labor market can help reduce unemployment and improve workforce participation. This includes measures to increase labor market flexibility, support for vocational training, and incentives for hiring young workers. Enhancing the efficiency of the judicial system is essential for creating a predictable business environment. Reducing the time and cost associated with legal proceedings can improve investor confidence and attract more foreign investment. Strategic investments. Investing in digital infrastructure and promoting digital literacy can drive productivity and innovation. Expanding high-speed internet access, supporting tech startups, and encouraging digital skills training can position Italy as a competitive player in the global digital economy. Italy has significant potential to lead in the transition to a green economy. Investments in renewable energy, sustainable agriculture, and green technologies can create jobs, reduce environmental impact, and enhance long-term economic resilience. Upgrading transportation, energy, and communication infrastructure can stimulate economic activity and improve regional connectivity. Targeted investments in infrastructure can also help bridge the economic divide between the North and South. Education and skills development. Modernizing the education system to align with the needs of the labor market is critical. This includes updating curricula, promoting STEM, science, technology, engineering, and mathematics, education, and fostering partnerships between educational institutions and industries. Encouraging lifelong learning and continuous skill development can help workers adapt to changing job requirements. Providing access to vocational training and upskilling programs can reduce the skills mismatch and enhance employability. Policy implementation and governance. Ensuring political stability and consistent policy direction is crucial for building investor confidence and enabling long-term planning. Building consensus across political parties on key economic reforms can provide the stability needed for sustained growth. Strengthening governance and institutional frameworks can enhance policy implementation and reduce corruption. Transparent and accountable governance practices can improve the efficiency of public spending and foster a more favorable business environment. To illustrate potential pathways to recovery, it is helpful to examine successful case studies from other countries that have faced similar challenges. Germany's labor market reforms in the early 2000s, known as the Hartz reforms, provide a valuable example of how targeted labor market policies can reduce unemployment and boost economic growth. The reforms included measures to increase labor market flexibility, promote vocational training, and incentivize job creation. As a result, Germany experienced significant reductions in unemployment and improved economic performance. Ireland's transformation into a digital economy powerhouse offers insights into the potential benefits of digital investments. By investing in digital infrastructure, attracting tech companies, and promoting digital skills, Ireland has become a hub for technology and innovation. This transformation has contributed to robust economic growth and job creation. South Korea's green growth strategy demonstrates the potential of green investments to drive economic recovery and sustainability. By investing in renewable energy, green technologies, and sustainable practices, South Korea has created new industries, reduced environmental impact, and enhanced energy security. The strategy has also positioned South Korea as a leader in the global green economy. To wrap up, Italy's economic recovery from its prolonged downturn is a complex and multifaceted challenge. While the country faces significant obstacles, including structural inefficiencies, high public debt, and demographic pressures, there are also opportunities for growth and renewal. By implementing structural reforms, making strategic investments in digital and green economies, and improving education and skills development, Italy can enhance its economic resilience, and competitiveness. Ensuring political stability and effective governance is essential for creating a favorable environment for investment and growth. Recent studies and historical examples highlight the importance of targeted and well-executed policies in driving economic recovery. Italy's path to recovery will require a concerted effort from policymakers, businesses, and citizens to build a sustainable and inclusive economy. As Italy navigates the challenges and opportunities of 2024 and beyond, the key to success will lie in its ability to adapt, innovate, and implement effective policies that address both immediate needs and long-term goals. With the right strategies and commitments, Italy can overcome its economic difficulties and emerge stronger and more resilient in the years to come.